Hi everybody, this is Henry. Today I'm going to talk about 7 best uses of my News Profiteer currency meter, also known as the currency strength meter. I get asked this question a lot about how to properly use the meter, what are some of the tricks for this meter, and today I'm going to try to cover that. Now the first use for the currency meter is immediately after a high impact news release. Now obviously this meter was built for this purpose, and that is the primary way of using the meter. Let's say that we do have a strong release that just came out from UK, and our focus obviously is going to be on its currency, which is the Great British Pound (GBP). And we're seeing that after the news, pound is showing a 7.3 of strength. Now we have several pairs that we can trade with the GBP, with the sterling. And number one is obviously the GBP USD, and the USD is showing a 2.9. Not too bad. The second pair is the European crosses, which will be the Euro Pound, is showing a 5.5. Obviously, it will not be my first choice because what we are trying to do is we're trying to match the a strong pair with a weak pair, all right, so that we can expect the maximum movement from these matches. So obviously, if you were to choose between the euro pound or the pound dollar pair, you'll choose the pound dollar. But you can further look at the pound CAD, which is showing 1.7, or you can look at the pound yen, which is showing 1.8. Now, obviously, my trading style involves only with the major pairs, and I try to stay away from different crosses, such as the pound CAD or the pound Audi, which doesn't really have that much volume. So I want to only concentrate on the ones that has a little bit more volume, a little bit more popular pairs, and I try to stick with several pairs that I use most of the time. So obviously, the three choices that I usually trade with the pound dollar is the euro pound, the pound dollar, pound USD, and the pound Japanese yen pair. And of course, all of these currency pairs, compared to the pound, we're seeing the Japanese yen actually showing a 1.8, and that is making this a much better pair to trade. So, of course, immediately I would be looking at the pound yen, and I would prefer to go ahead with a buy of the pound yen currency, buying the pound using Japanese yen. And this would be the trade that if you would take after a strong news, let's say a retail sales number that just came out from UK, and you have a favorable number for the sterling, this, by choosing the right pair, will probably give you at least a 30 to 50 pips more gain compared to maybe the pound dollar, and probably will give you a more possibility for a breakout. And if you would hold on to your trade, probably see more of a profit. So this is the number one way of using it. What you're trying to do is you're trying to match a strong pair with a weak pair. Now, of course, if you were to trade the pound with the euro pound pair, what you will see is a little bit strength on the pound, but since the euro is still strong, the movement on the euro pound will probably be very limited. So on the same trade after the news, you'll probably end up making 50, even 100 pips more trading the pound yen, buying it, than to be selling it on the euro pound. So that's the first way of doing it. Now, the second way of trading is of using the meter is really to identify the market trend. Gives you a snapshot, what I call also an at a glance view of the market. Now, let's say that you are looking to trade the London market. I'm in the US New York Eastern Time Zone. So for me to be trading the London market, I have to wake up, let's say around 3 a.m. in the morning, my time. So when I wake up, the first tool that I use is my strength meter. And what I do is I look at the market immediately, and I have an idea of what's going on. Now, this tells me a lot of the story of what is going on in the market, and it will help me to shift my focus to the right side of the market. Now, of course, knowing that it is a European market, you know that we have to concentrate on the euro pairs, right? So what I do immediately, and I look at the euro, the pound, and the Swiss franc. And of course, you also have to pay attention to the dollar and the Japanese yen, since they are the most traded currencies as well. But by looking at the market trend immediately, you're seeing the euro showing at 650, and the dollar showing at 610, and the pound showing at 170. And then you look at the Swiss franc, is showing at 5.2. So what you're seeing in essence is that you're seeing the Swiss franc is showing strength, the euro is showing strength, and the dollar showing strength. And the only weakness is the British pound. So this to me looks like a one-sided market of selling the sterling. So of course, at this moment, I would be looking at my chart, trying to identify where we are with the sterling against the dollar and sterling against the euro. So now I will have a better idea of what's going on in the market. Now, by seeing that the sterling is being sold off against the euro and against the dollar, pretty much say that it is being sold off across the board. And if I see a sterling sell off across the board, there must be a reason why this is happening. And I will then look to see what is the reason that the sterling is happening. It could be that the Bank of England came out with some kind of announcement. It could be one of the BOE officials saying something that's spooking the market of sterling. So if that's the case, I will just have to identify that, and then I'll determine if there's any trade that I should take with the sterling. Let's say that I'm looking to enter at a support level to buy the sterling when the market reaches a certain level. But because of the fact that it is showing a 1.7 and is losing across the board, I might be hesitant of jumping into that trade, of buying sterling, because today might not be the day to be trading sterling. The fact that everybody is selling off sterling means that we could see a breach of the support. So if that's the case, I'm actually reading the context of the market. And for me, I will probably have to look at the market further before I determine whether or not I should be jumping on a buy sterling trade. So of course, looking at this, immediately I will say, you know what, maybe I'll be selling the pound dollar or the pound yen. But of course, I think the pound dollar will move more, given the fact it is 170 versus a 610. Buying the euro pound would also work out. So it's just matching these currency pairs so that you can basically gain more profit. But this gives you an at-a-glance view of the market. You don't need to look at the pound dollar chart. You don't need to look at the euro pound chart. You don't need to look at the pound yen chart. By looking at this, you already know what you need to do, and then all you need to do is just to confirm. All right, so it saves you a lot of time, and by seeing that currency is weak, you now can spend your time researching on why it is weak. And if you find a reason for it to remain weak, then maybe instead of buying it, you can sell it. So this is a very, very time-saving way of using the strength meter. And I recommend that whenever you look at the market, look at the meter first, know what is going on, because this one gives you a snapshot of what's going on at the precise moment. And for you to have that instant analysis on the market, for me, it's invaluable. Now, the next way of using it is to identify risk aversion sentiment. Now, we all know markets being driven by risk sentiments. And risk sentiment meaning that the whole market collectively are driven by emotion. So basically, a risk aversion means to avoid risk. Traders want to avoid risk. Now, risk is always associated with return and volatility. So when we have a risk aversion sentiment, we're going to see something typically and with the strength meter, and that is a strong dollar and a strong Japanese yen. All right. So when you see a strong dollar with a strong Japanese yen, that usually means we have a possible risk aversion sentiment. And when we have a risk aversion sentiment, there are several ways of trading the market. Knowing that number one, when we have a stronger dollar, stronger Japanese yen, you can sell all of the yen pairs, such as the pound yen, the euro yen, the Audi yen, the CAD yen. all of the Japanese yen pairs should start to move down because the yen is going to start gaining strength across the board, and most of the times even more so than the dollar. And of course, high yield currencies, we know that yield is basically the easy way to identify them is their official interest rate. We know the Audi is at 4%, and the New Zealand dollar is at 2.5. So we see 2.5%, 4%, they're kind of high. And the pound dollar, although is only at 0.5%, it is a very volatile pair. So when we say volatility and return, the high returns and the volatile pairs tends to really suffer in a risk aversion sentiment. So when you identify a strong dollar and Japanese yen at the same time, basically tells you it is a risk aversion environment. You could just go ahead and sell the pound dollar, sell the Australian dollar, sell the New Zealand dollar, sell the pound yen, sell the euro yen, sell the Audi yen, because all of them are the primary targets for a risk aversion sentiment. And of course, once you see your meter giving you a risk aversion type of scenario, what you need to do is you need to also verify what is going on in the market. And of course, as fundamental traders, I always want to find out what's the reason. Is there another banking default? Is there a ratings downgrade? Is there some kind of negative news that's affecting the market? If there is, I want to see how strong the news is. But that's a totally different story. What we're looking at is the strength meter, and once you see this is what's going on, it will give you a head start, and you can start to really look at the market. And basically, your whole day will give you a direction of trading. You know that you're going to be buying the dollar, you know you're going to be buying the Japanese yen the whole day, as long as you're seeing this type of pattern on your strength meter. Moving on, the fourth way of identifying is to identify a risk appetite sentiment. And risk appetite basically means demand for risk. And what is risk? Risk basically is associated with return. So when you have more volatile and more return, that's what you want. So it's basically a complete reversal. We're going to see a weaker Japanese yen, and maybe not as weak as the Japanese yen, but the dollar should also remain a little bit weaker. Usually on a risk appetite sentiment, we see a weak Japanese yen. Maybe the dollar will follow, maybe the dollar will not follow, but it's usually a strong sign that the Japanese yen is weak. Now, when we have a weak Japanese yen, you can trade. The more volatile pair is the pound yen. It will usually give you a very good movement upwards. The euro yen is another great pair to be trading. And the next one is actually the Audi yen, will also give you a good movement upwards. So by looking at all these pairs, you could basically choose the best one, and by identifying that it is a risk appetite sentiment showing a weak yen and a weak dollar, what you can do is you can just choose the best looking pair, hold on to a trade, because usually when we have a risk appetite sentiment, market tends to move and tends to continue that move throughout the entire trading day. So if you identify this during a London session, you might be able to hold on to this trade until the New York session. So there's a lot of ways to be trading this, but the idea here is to really being able to identify the sentiment, and once you are able to identify the risk sentiment, you can basically follow it, and it will give you absolutely a good return and a good profit. Now the next way of using the strength meter, this is one of the things which I like to focus on a little bit more, and it is basically knowing that the principle behind the strength meter is actually pretty simple. And I have explained this in my blog a little bit, but let me just go ahead and give you a quick overview. The strength meter basically works with the daily ranges, the range of the day. Right? So when we start early day, let's say around 5 p.m. in the afternoon, the strength meter is just starting, it's just gaining data. So after a couple of hours, it has gained the data, it will start showing you the strength. As the market starts to move up and down, strength will adjust according to the daily ranges. Okay, so what's the daily range? It's the high and the low of the day. And the day starts at 5 p.m. It ends at 4:59 p.m. the next day if you're in the New York time zone. So it calculates the range, and when you're at the top of the range, right, the number is likely to be high. And when you are at the low of the range, the number is going to be low. So it's pretty straightforward. But what I do is we take 19 currency pairs and we look at where are they. Well, are they in the top of the range? Are they in the bottom of the range? And we divide the range by a percentage. If they're right in the middle of the range, is 50%. If they're on top of the range, then is 90%. If they're on the bottom range, it's 10%. So you add all of those ranges up together, and then you take out some of the extreme ranges, and then you average them. And with the average, we came out with all of these numbers, all of these from 1 to 9. 9 being the strongest and 1 being the weakest. And as you can see, weak, it goes with blue, and then yellow. Yellow is a universal sign of warning. So once it turns yellow, it means it's normal, and then orange is a higher degree of warning, and then when it gets to red, it's basically disaster. So I use that to identify, to visualize the strength of the currency. So by knowing that we're actually using 19 pairs and we average them out, and knowing how the market works, you can see that when you enter a trade, when the market is showing 7.7, when the market goes above 7, it turns to red, and 8.8 is red. When you are above 7 and you're trying to buy at 7, you're really buying as the market is moving up. Okay, and when you are selling, when it is blue, you are selling as the market is moving down. Okay, so always know what the meter means and what you're doing if you're looking at this meter to trade, because some trading methods involves following the trend, so you buy as the market is moving up. Some of the trading method is completely opposite. You buy when the market is down and you sell when the market is up. So it depends on what kind of trading method you're using. All right, and of course, when you are looking at these numbers, you're not really looking at just one pair. You're looking at a combination of many pairs. In order for the number to show a red number, it means that all of the Japanese yen pairs are roughly around the top of the range. Okay, and when you're looking at a blue, that is telling you that all of the dollar pairs are at the bottom of the range. So this is basically telling me, if I'm seeing the USD at 1.1, it's telling me that the euro dollar is really high, the pound dollar is really high, the dollar Swiss franc is really low, the dollar CAD is really low, the Aussie dollar is really high, the dollar Japanese yen is really low, and the NZD dollar is really high, and they're all on top of the range. Okay, so when you refine your entry, when you are planning to enter your trade, usually, and that's just my trading style, I'll be a little bit careful when the market is either red or blue. Because when the market is either red or blue, meaning we're on the top end of the range, and being at that range, the market could reverse back. Okay, so just understand what you're getting into, and when you use the data from this, knowing that you're on the top or you're on the bottom of the range, so that you can refine your order entries. Now, the fifth way of using this is to use it and identify a pullback. Okay, usually the market start to push forward, and you're looking for a retracement, and I do that a lot. I like to wait for a retracement before I jump into the market. So what I like to do is I see the market showing red anywhere from 7 to 9. So what I like to do is I like for the market to pull back to somewhere around the orange, around 6 point, anywhere above 5. If I get as close to 5, but not below 5, then it's telling me that the market has done a pullback. And when I see that pullback, usually means it's time for me to enter. Okay, especially during news trading, if you're waiting for a retracement, let's say that we do have a good news. Going back to the first example, we have a good news. Let's say that we're looking to buy the pound yen pair. Okay, now the pound is showing 730 and the yen is showing 180, and that gives us a good trade. Now let's say the pound yen is keep on going up, and what you don't want to do is you don't want to buy at this level. You don't want to buy because you don't know if it's going to pull back. What you want to do is you want to wait for a little bit of pullback and then buy from the bottom level as it makes that pullback and then goes right back up, right? That's usually the best way of trading. And so when this pullback happens, usually the pound will return back to the orange color. And that will help you to identify a pullback. So don't buy when the market is red, especially if you're waiting for a retracement. Wait for the market to show you an orange before you jump in on a trade. And that usually will give you a pretty good entry, much better entry than when the market is red. Now, of course, if you have a strong news and the news doesn't seem to let go, then you have to make a decision whether you want to jump in when the market is still red. Normally, I like to wait for the market to come down a little bit before jumping in, because buying on the top, usually you will see the market reverse, and then you will end up with the loser on your hand. And even if it's going to work out, you have to suffer, hold on to the trade a little bit. And if you're one of those careful traders that like to be very careful and put very tight stop loss, you could end up losing on this trade. So that's the number 6 way of trading. And number 7, identify a reversal. Now, of course, when you're in a trade, the market gives you a strong red number, and then from that point on, it starts to go backwards. All right, and it goes to red, goes to orange, and you keep on going backwards, until you see yellow, and then you see blue. Now this is a complete reversal of the market. So it is always, in my book, when the market goes from red to blue, or from blue to red, vice versa, it doesn't matter. You could go either way. It basically means that the direction of the market has changed. So when I see this happening, it means that I need to change my view, and I also need to start going the other way. Because remember, the daily range, okay, this is the high end of the range, right? And this is the low end of the range, okay? The market, it goes too high and it is red. When it comes down to the middle, right, it is around the yellow area, right? And when you get close to the lower end of the range, that's when it starts to turn blue, okay? And no matter what the news is, right? If you have favorable news for a particular currency, okay, or you don't have a favorable news, the market is now showing you blue, okay? It's showing you blue at this area. This is where you need to think maybe you're getting it wrong. So this is the time for you to, instead of thinking about buying, you need to start selling, okay? Sell. So I know a lot of times when we analyze the market, we see the market and we get a news. Let's say, we're expecting a certain deviation, and we did get our deviation, and the market started to move up. And then it did a whipsaw, it turns, and so instead of a moving up, we're seeing the market moving down. And at this time, you might think that, hey, the number is good, everything's pointing up. Why the market is moving down? Okay, instead of trying to answer that question, why? Don't argue with yourself, because if you get into an argument with the market, you will lose. Market will always win that argument. So what you need to do is once the market starts to turn from red into blue, I would say that when it turns into yellow, okay, that's when you have to be neutral. Now, when it sits at yellow, you have to say, it now is a possibility that we could see a reversal here. So that's where, if you're close to your entry level, maybe this is the time you need to take profit, or this is the time that you have to think about closing off your trade. When it goes to blue, that means by all means get out of the market or take a reversal trade. So that's it, everybody, and this is the 7 ways of trading, and I hope I'm able to show you some of the new uses of this News Profiteer currency meter. And if you have any questions or any comments, feel free to email me or to leave a comment on my blog. It's called currencystrengthmeter.com. Thank you very much. This is Henry Liu once again, and best of luck in your trading. Thank you.